Okay, I think Ravi is back with us. Ravi, hi, good morning. Can you hear me clearly?
Yeah, good morning, Aisha. Thank you so much for having me.
Okay, great. Hope all's safe. Now with this, spike in cases, one is a little worried yet again.
Yeah, so far so good. Hold up in a bubble, working from home, but touch wood. So far so good. I hope the same with you.
Great, great to hear that. Yeah, absolutely. Touch wood. Fingers crossed so far. Ravi, last time when we were speaking in the month of January, you had talked about as to how the run-up from last March has been like, the beginning of a new bull run. Having said that, you also did predict that the market is going to see some volatile bouts coming in. Volatile it surely has been. And then, of course, the market saw that knee-jerk reaction play out on Monday earlier this week, when news of a possible lockdown in Maharashtra came over. Would you say that now with this second wave and this big spike that one is seeing across states, not just in the state of Maharashtra, and curbs and curfews and mini lockdowns getting implemented everywhere, has the market texture gotten broken or derailed in any sense?
Yeah. Thanks, Aisha, for the question. Let me just start by putting in perspective what are the legs on which this bull market is, running. So we started with the premise, or the start of this bull market was from very low valuations, and we have had fantastic rally. So yes, valuations have run up a lot. So, but at the same time, the earnings also have been good. So you can't say that only prices going up is valuations getting expensive. One was the valuations being cheap. Second was the money being available and in abundance and cheap. Third was the falling cost scenario. And the fourth was rising return on equity because of growth coming back and earnings growing. So a combination of all these factors led to the bull market starting. Now let's try and visualize if these factors are still in play. So to some extent, the liquidity scenario and the cheapness of money has gotten deteriorated at the margin. But at the same time, the micros are still very much improving. So the consolidation within sectors and the larger guys or the more efficient guys getting more market share and margin improvement is still panning out. So not everything that this bull market was based on has deteriorated. Only some marginal deterioration at the margin is happening. So one has to be a little careful, but at the same time one has to stay invested and stay positive from a medium term point of view.
Sure. Ravi, you often mentioned that deep cyclicals are, is that one space which is going to do well as the economic recovery continues. Just in the very near term, does that thesis and prognosis get challenged because of, again, this second wave that one is seeing?
Right. Sorry, I forgot to address the COVID second wave in your first question, but let me take it
Guys,
now, along with this. So, see, the second wave is seems like a redo of what happened in the March, April, May, June of last year. But essentially, from market's point of view, it is not the same. At that point of time, it was a source of big surprise, a big unknown. We had no idea how the world will react, how the governments and the central banks of the world will react, or how much it will contract. So on all those fronts, the things are actually now at this juncture, we can now to some extent, estimate or what kind of impact can it have. It is not going to be a national lockdown. It is not going to be a global lockdown. It's going to be a more localized response that we are going to get from the government. At the same time, we have seen that if things get too worse, the governments and the central banks of the world are ready to do whatever it takes to revive the global economy. So to that extent, second wave of COVID is not such a big risk. Having said that, for sure, the services or the businesses where direct touch of human involvement is there, those businesses are going to suffer a bit longer than they have. And most of the other businesses have had the chance to recover quite quickly. So yes, some amount of recovery can get dampened, especially in these sectors. On the cyclicals front, I feel as it is a combination of two things, volume as well as value. So because of the supply constraint, and it is the impact of supply constraint is far larger than the impact of the demand growth. So and the supply constraints actually get aggravated because of COVID. So to that extent, the prices of the commodities and the cyclicals or the goods are likely to stay elevated, and that impact is unlikely to percolate down into the earnings. So volumes might get impacted here and there because of supply constraint, but larger guys who can take away market share will benefit from this dislocation.
Okay, so let's talk about metals then, since we're talking about cyclicals. We've seen a phenomenal rally play out in the entire metals basket. I was just looking at the 3-month move in the metals sector, and that with the market volatility also is a solid 26% uptick for the sector, and I'm not even getting into individual names here. Would you say, that while there is no taking away from the fact that good gets better, but is the best yet to come, Ravi?
So, see, the commodity cycle and commodity booms are born on the supply shortage. And supply shortages develop over a long period of time. And usually they die on crazy M&A and huge capacities coming on stream. None of that is happening in the immediate term. Yes, because of the rising prices and because of the huge increase in profitability, for sure, there will be a lot of announcements of new capacities down the road, but it is not going to happen in a hurry. Capacities take time to come up. So some amount of correction in the prices of the commodity cannot be ruled out, but I don't think we are going back to the levels that were seen earlier. An elevated level of prices are going to remain, and that will feed into the high profitability that these players are going to see. So the kind of EBITDA per ton most of these guys are going to make are going to be higher than probably what they had made in the peak of the 2003 to 2008 boom. So, and this does not seem like the end of it. So I would say that the elevated profitability is here to stay for some more time.
Ravi, in your own words, in 2020, the world understood and discovered the importance and value of pharmaceuticals. And more importantly, I would say, it's now becoming a more high beta name. Just the beginning of this wave of, or rather the second wave and the spike in cases, and you already had pharmaceuticals and, diagnostic names and what have you, again, pick up after 3 months of slight consolidation in the sector. Where do we stand a year from the pandemic and with this spike in cases now within pharma, which is a very well-discovered story, if I can call it that?
Right. So you're absolutely right, Aisha. The market seems to be zigzagging between the cyclical recovery and on the COVID plays. And right now, pharma seems to be categorized as a COVID play. However, my thesis has always remained that pharmaceutical sector in India is a far more than just a COVID play. And the beginning of this bull run in pharma is not based on COVID, but it is based on improvement in US oral solid generic pricing environment. So that, as long as that continues, I think still the pharma sector is not valued to an extent where one should be looking to get out. The kind of investment that these players have done from 2015 to 2019-20, all those R&D dollars are yet to show results. So yes, COVID can be a short-term accelerant, but the story of pharma is far beyond COVID, and one should not be treating it as a beta sector, as a play on COVID or play on lockdowns. But look through it, there's a definite and sure shift that is happening towards India, not only across supply chain, not only in terms of formulations, but also in terms of API. And these players are likely to become larger over the next 5 years, and one should stay focused on that 3 to 5 year rather than on the next 3 months, 6 months, because the lockdowns and the COVID will have its ebbs and flows, and sooner or later we'll have to have a hypothesis which is beyond this.
Sure. If I were to ask you, Ravi, that within the larger pharma slash healthcare universe, what are the prospects of hospitals and diagnostics? Are they on a solid footing? Because, up until last week, you had the non-COVID treatment and tests as well pick up. Now, of course, things have changed a lot. They have the low base as well, favoring them. But do you think that can be coupled with higher realization, and this space in particular, that's hospitals and diagnostics, can take the lead? Because again, in the last 10 odd days, if I were to just map, how the diagnostic names have performed, or for that matter, even in the last month, some solid gains there.
I'll try and separate the two sectors, even within the healthcare. Diagnostics and hospitals I'll take separately. So let me first address diagnostics. So see, India is an underpenetrated market in terms of diagnostics. We are still, most of the cost of diagnosis is borne by the consumer at their own end. We have to reach a stage where insurance takes care of most of these costs. In terms of physical distribution and penetration also, there's still a lot of scope there. So there's a large runway available, and this sector can continue growing between 10 and 15% for a long period of time. Having said that, the current valuation seem to be factoring in way beyond the current, long-term 10 to 15% growth. I think the bump up in the growth numbers because of COVID is leading to a lot of market participants extrapolating the current growth trend for a long period of time. So I would just caution in terms of, an entry point for these companies. But at the same time, these businesses are super squeaky clean, fantastic balance sheet, long runway, fantastic return ratios. So diagnostics remains a space that one should keep on the radar all the time. But an entry point is what one should be a little more skeptical or circumspect about at this point of time. Coming to the hospital side, the same story continues. Our number of beds per population or the kind of infrastructure, health infra that is there in India has a long, long way to go. But hospital is a capital intensive business. It takes time. And again, as long as the hospital expenses are to be borne by consumer at their end, it will remain an underpenetrated category. We need insurance to come in. The health insurance actually is a better way of playing the formalization of the healthcare in India. But once the the insurance penetration picks up in healthcare, then the hospitals are also likely to see a huge expansion. And this is a business that cannot be created overnight. Once a hospital has established itself, it is very difficult to dislodge. And then it is like a retail model, so to say, and then it becomes a cash flow throwing business at the hospital level. At this point of time, many of these hospital companies have their top 10% of their hospitals doing very well. And they have a long tail of, 70 to 80% of the hospitals that have been set up in the last 3 to 5 years. And they are not yet fully gestated and they take time to break even. So the overall numbers do not look attractive in the hospital business. But again, a long runway, a business that cannot be disrupted but is throwing money at it. And it's a business that one should be invested in, but with a very, very long-term view.
Ravi, what's the outlook when it comes to engineering and capital goods? Because there have been strong signs of recovery in the form of the capex allocation that we've seen to the sector, the PLI scheme as well. A boost to domestic manufacturing definitely came in, and there are visible signs of recovery in the overall capex cycle. But then this resurgence of COVID is definitely not going to bode as a good sign for a lot of these companies. So what is it that you're expecting in terms of the quarterly earnings, in terms of the performance of these companies in long-term growth?
Right. So see, you're absolutely right. These businesses will have fits and starts time to time because of COVID. And I wouldn't say, 2003 to 8 is the one capex cycle that is very, very prominent in all our mind. In the last 3 decades, that was the one that where some real infrastructure building happened and a lot of companies changed lean. So when I juxtapose the current situation to that, we are not yet at that stage. See, steel, power, telecom, these were some of, and coal mining. These were some of the sectors that actually, picked up the bulk of the capex, private as well as government in the previous cycle. This time around, the steel boom has just started. The capex is not yet to be seen for greenfield. Telecom capex also remains constrained due to the balance sheet situation of most of the players, and the number of players have shrunk dramatically. Power as well, no major capex is happening. So this time around, the contours of the capex cycles are very different. One, it is not a cycle that is all pervasive. It is a very, very localized and specific niche opportunity that one should be focusing on. So, for example, water is one such water is one such space where there is a lot of capex happening. Second is a lot of capex is happening on the ethanol or compressed biogas or companies that are focusing on green technologies. Wherever the government pushes there, and where there are companies available which are much smaller in size as compared to their addressable opportunity, that is the space that one should be focusing on from capex cycle point of view. So overall capex cycle is unlikely to revive, but there are pockets of pockets which can do well. Another small pockets is chemicals and pharma. These are the companies that are doing a lot of capex. So there are small plays available in this space.
About the kind of outlook that you have for the FMCG or the consumption space, because there have been strong demand trends on the one hand, the weak base as well that we saw from last year, and yet again there's that niggling worry with respect to the clear pressure that we could see on the margins due to the raw material inflation. Is it glass half full or half empty when it comes to this space?
As a space, I would say it's glass half empty. And primarily because the odds are not stacked in your favor in terms of valuations. The growth is not okay. There was a slight bump up in growth in essentials when the COVID first emerged last year, but that turned out to be a more short-term phenomena. And now the margin pressures are going to emerge. So the combined factors of growth remaining subdued due to the second wave of COVID, and add to that the margin pressure because of commodity inflation and high valuation, is going to ensure that FMCG stocks overall remain a subdued lot for the foreseeable future. However, having said that, again, few pockets cannot be ruled out within the FMCG where current valuations are not that demanding. And so, for example, if I were to say, liquor companies have not yet performed at all over the last 5-6 years, and they're still facing the brunt of the COVID situation. But however, there are some medium-term changes happening over here because the players are ceding space. They are trying to, apportion their portfolio. They are trying to cut down the excesses in their portfolio. Cost cuttings are happening, and distribution is getting a leg up because of online thing. So that is a space, I would say, which is within FMCG where some amount of positivity can remain. Having said that, it is not a true FMCG because the pricing power doesn't exist for these liquor companies. So it will become it is a consumer item, but it is not FMCG because the distribution is limited and pricing power is not given to these companies.
Ravi, the other space that you track very closely besides pharma is also specialty chemicals. Now, the only thing here is that specialty chemicals is a well-discovered story, and even pre-COVID. So, in that sense, the sector has already moved up. In the near term, though, would you say that A, growth momentum would continue, and B, would volatile commodity prices bear heavy on the margins in the near term? And if at all, if there is some impact or dent on the margins in the near term and the stocks do correct, would that then be a lucrative buying opportunity to add more positions to specialty chemical names?
I would think so. I think you have hit the nail on the head over here. Specialty chemicals is a story that started much before COVID. China plus one strategy got accelerated due to COVID, but the pollution problems in China were already leading to some kind of supply chain issues for most players globally, and that was making most customers in Europe and US look for alternative vendors, and they were in the process of developing their supply chain in India. If anything, COVID made them tilt on this side of the and made them reach their decision faster. So they actually what was a promise is now getting converted into numbers that we'll be able to see. This quarter is going to be one of the best quarter for a lot of these specialty companies. And I don't see any reason for that to change in the medium term as well. You are absolutely right. Some amount of raw material inflation can lead to some margin deterioration, but it is likely to be as long as it's a specialty chemical and not a commodity chemical, and your entire hypothesis is not based on prices of those chemicals going up, I think these players will adapt with a quarter's leg to the rising raw material scenario. For most of them, it is a pass-through. And one should be, they do their business at EBITDA per ton or EBITDA per kilo basis and not at 20% margin or 18% margin. That's how the market tends to look at them. So there is a possibility that most of the cost inflation will be passed on. Maybe there is some amount of impact, but the medium term story still remains intact. And these relative size of these companies is still way, way small than what it can be over the next 5-10 years.
Have you on board. Thanks much for joining in and sharing with us your outlook on the markets and giving us a view as to where it is that you are looking at by way of opportunity in this market.
Thank you so much.